Hello and welcome to another episode of the Forex 101 series. In today's episode, I'll be explaining what market structure is. A lot of traders do not know what market structure is, and market structure is one of the most important concepts that a trader needs to know for him to become profitable and understand the market in a way that will allow him to be confident in the trades he takes and the analysis he makes. Let's get into the lesson. How to read market structure. Reading market structure is important to help you become a profitable trader. It helps you become profitable in a way that you become confident in your analysis because you know how to read the market, and you will also be confident in the trades you take because if you're confident in your analysis, you'll be confident in executing your trades. Before we begin, what is market structure? Market structure is simply what trend the market is in, either uptrend or downtrend. I'm sure by now you may have known what uptrend and downtrend is. For those that do not know, let me know in the comment section below. This is the fundamental concept you need to know in order to become better at technical analysis. Without the knowledge of market structure, you will mostly find yourself placing a trade in the opposite direction of the trend, which is, sorry for the error, which is the number one mistake beginner or struggling traders make. Why it is important to read market structure. Like I have already mentioned, reading market structure is important because it allows us to take a trade in the direction of the trend. Taking a trade in the direction of the trend allows us to maximize profit by allowing us to risk less and gain more. Reading market structure also allows us to be confident in our trades, like I have already mentioned. It also allows us to be confident in our analysis. And when we are able to read market structure, we will be able to take trades in the direction of the trend. And if we take trades in the direction of the trend, we will be able to risk less and gain more because we will be able to take advantage of the impulsive moves rather than placing trades on the retracements and ending up losing the trade because we do not know where the market was actually moving. So here's an example. So as you can see here, price is in a downtrend and we took a trade in the market's direction. See how we risk less to gain more. So you see, we risk less here and gain more because we were placing a trade in the direction of the trend. Price was making lower highs and we took an opportunity here, waited for price to make another lower high so that we can take advantage of the opportunity and maximize our profit rather than taking a trade on the retracement. This is the same level here but different trade. In this case, we are seeing it in the eyes of a person who does not know how to read market structure. You see how taking a trade against the trend does not allow you to maximize profit. So you can see in this case, a trader just takes a buy because he sees a pin bar here and it's on a significant level and he just decides to take a trade. He opens a trade, it hits his take profit level here, his first take profit level here, and probably his second take profit level is here because of the significant moves that price made from these levels. So after he takes this trade, it hits his first take profit, he continues holding his trade, and out of failure to accept that the trade is reversing, which most traders experience, and I'm sure you have also experienced it, and price begins to reverse, he is ignorant of closing the trade because he is thinking the market will reverse in his direction. This is where price comes and takes him out of the trade. So you see why it is important to take a trade in the direction of the trend. It allows you to maximize your profit. So it is important to know what trend the market is in so that you can take a trade in the direction of the trend. I am not saying that taking a trade on a retracement can't give you profit, but the risk to reward ratio is poor and will not allow you to maximize profit in the long run. Like I have always been saying, profit in the Forex market or in any financial market, whether it's stocks or option trading, profit comes in the long run. Reading market structure will allow you to be more confident in your trades because you will be sure of market direction. Having confidence in your trades will allow you to execute trades without hesitation. You can see that I have put execute in capital letters because execution is also fundamental for you to become a profitable trader. Usually most traders have fear of executing a trade, maybe after a streak of losses, and they will associate their streak of losses with their present trade and they will not enter the trade. After some time, they will find out that the trade that they were scared to enter actually went in their direction. But if you are confident in your analysis and you are confident in the direction of the trend, you will be able to take trades in the direction of the trend without any further hesitation because of the level of confidence you have. Having confidence in your trades will allow you to hold your position without constantly checking your chart. This comes with practice. A lot of beginner or struggling traders have this habit of constantly checking their charts because they are anxious of what price will do. They think price will come back and hit their stop loss, but this is a bad habit. It is important to accept the risk in trading because this is part of the game. If you do not accept the risk, this is a habit that you develop. Learn to accept the risk. Whenever you place the trade, make sure you place the trade with good risk management so that you can allow the trade to run without you constantly checking your chart. And also make sure that you have taken the trade in accordance with your trading plan. Make sure the trade is in the direction of the trend so that you are confident in holding that trade. It will allow you to stay strong in the face of uncertainty. Like I have said in my previous psychology videos, trading is all about staying strong in the face of uncertainty. You will never know which trade is going to be a win or lose. All you have to do is place a trade, and how profitable you are going to be depends on how strong you are in facing uncertainty of what the market will do. One element of becoming a profitable trader is how mentally strong you are in the face of uncertainty. When you are confident in your trades, no matter what other people say about the direction of the market, you will stick with your analysis, discarding the rest. This is if you are genuinely confident in your analysis. How to read market structure. After explaining what market structure is and the importance of market structure, you may be anxious and wondering, asking yourself, how can I read market structure? Well, let's get into how you can read market structure. There are multiple tools you can use to determine market structure. The most important and the ones I will be explaining are price action, trend lines, the moving average, and the Fibonacci tool. We'll begin with price action. I am beginning with price action because this is the most important of them all. Price action is the raw data showing the battle between bulls and bears. For those that do not know what bulls and bear means, it's simply buyers and sellers. Bulls for buyers, bears for sellers. This is usually the language used in the financial markets. Meaning, we are reading exactly what the buyers and sellers are doing and figuring out who is currently in control of the market. This is what price action is. It's about reading the price and figuring out who is currently in control of the market. Is it the bulls or is it the bears? We figure out the trend of the market using candlesticks. This is how we figure out the trend of the market. To identify the trend of the market, you have to go on higher time frames because the higher the time frame, the more significant the level and structure are. So when you go on the higher time frames, like I have already explained in my previous support and resistance video, the higher the time frame, the more significant the levels are. On the higher time frames, the levels and structures are respected very well rather than on the lower time frames. So if you're looking to place key levels, I suggest you place key levels on the higher time frames and you look at the structure on the higher time frames. This will help you identify the trend on the lower time frames also. So we begin how to read price action. So this is the monthly time frame. This is Aussie dollar, as you can see from the price here. So on the monthly time frame, you look at the momentum of the market. Is it up or is it down? How you can determine the momentum of the market is by asking yourself, is the market making lower highs or is it making higher highs? So you can see here we've got a lower high, we've got another lower high here, and price is potentially making a lower high here because we have got this engulfing candlestick and it has respected the psychological level 0.700. After you have placed your key levels, I have already taught how to place your key levels on my previous key level video. You make sure to go watch it so that you know how you can place your key levels. After placing your key levels and identifying the momentum of the market, you go down to your weekly time frame. On the monthly time frame, we identified that the momentum was down, meaning downtrend. On the weekly, we now, sorry for this mistake again, on the weekly we now have to see if the two time frames are correlating. In this case they are, so our bias is down, and now we have to start looking for selling opportunities on the lower time frames. So you can see price on the weekly time frame is still making lower highs. So we've got a lower high here, we've got a lower high here, we've got a lower high here, and price has made a lower high here. We're expecting price to come reach down here at 0.6200. So on our lower time frames, we only look for selling opportunities. We only look for areas where we can sell on our lower highs. So now we go to our daily. Since we were expecting an impulsive move to the downside, on the daily we begin to look for signals that indicate a bearish impulsive move. In this example, you can see that price has broken the previous higher high. So this previous higher high here, you can see that price has broken this previous higher high. You can see it very well in the lower time frame, so we'll get to that very soon. So price has broken this previous higher high. You can see price was making higher highs here, higher high, higher high, higher high, higher high, higher high, but here we reached our significant level here, and price broke our last higher high here and created a lower high here, meaning down. So price has broken the previous higher high and has now shifted to a downtrend. For better entry signals, we step down to the H4 time frame. So from the monthly to the weekly to the daily, our momentum is down. So now we step down to the lower time frame, the H4 time frame, where we can look for selling opportunities. So here's the H4 time frame. You see how refined the levels are, and you see how we broke our previous lower high here. This is our previous lower high here. Price was in an uptrend. So in the previous slide I mentioned this as a higher high, but it's a lower high. In an uptrend, price makes higher highs, which are these, and lower highs, which are these. High high, lower high, high high, lower high. In a downtrend, lower high, lower low, lower high, lower low. So that's the difference between uptrend and downtrend, and we can see the shift in structure here. Proper shift in structure here, nothing complicated. on the higher time frames, guys. Lower time frames will just confuse your brain and you just start chasing the trade instead of waiting for the trade to come to you. So I suggest if you're a beginner trader or a struggling trader, you start with higher time frames, and when you become effortless in executing trades on higher time frames, you can step down to the lower time frames and start refining your lower time frame strategy. So here we had the previous lower high. Price came, failed to break this higher high here, created a double top, and began to decline here from our significant level here. You can see this sharp decline. So you can see that the momentum is with the bears, and the bears are in control of the market. We made a retracement back here to our previous support level. I explained this concept in the key level video, so make sure to go and watch the key level video if you are unfamiliar with key levels, support and resistance, and everything of that sort. So price was in an uptrend, but price reached its previous high. Price reached its previous high here on the weekly. You can see this line here. Price reached its previous high on the weekly, and we were bearish on our bias from the higher time, from the monthly time frame to the weekly to the daily. Our bias has been bearish, so we were expecting a trend reversal, and it happened. You see how clear the entry is on the H4 time frame. So you see how clear the entry is on the H4 time frame. Sorry, I made a mistake here and put $dollar time frame. Sorry for the mistakes I have been making in this slide. I'll make sure to correct them, and I will tell you where you can find this slide. Price shifted here, shifted the trend, made a lower high. This was a good entry level. You see how we can maximize our profit by risking less and gaining more. This is the power of knowing market structure. You should aim to mark key levels on the monthly, weekly, and daily. Here, this is the link to the video, so make sure to get this slide. Here is a video on how you can mark key levels. After you have marked key levels, I suggest you focus on the daily time frame structure because it is clear and shows recent price action. Hope you have understood what price action is. If you haven't, make sure to ask your questions in the comment section below, or you can DM me on Instagram. I'll make sure to give you our Instagram details at the end of this video. We come to trend lines. Trend lines are lines that help us with identifying market structure and giving us additional confluence for entering a trade. So trend lines can be used for both identifying market structure, identifying what trend the market is in, and they can also be used for additional confluence tools that can help us take a trade and have confidence in the trade that we have taken. So it's a multi-purpose tool. So how to apply and use trend lines? How do we apply and use trend lines? There are a lot of beginner and struggling traders that I see most of the time, and the way they plot their trend lines is inaccurate. So this is how you plot your trend lines. So you have to place a trend line after two impulsive moves. Make sure the moves are impulsive. So here, as you can see, we have one impulsive move. This is considered as an impulsive move. Then followed by another impulsive move. So impulsive move, retracement, impulsive move. So from here, you can plot your trend line. So I updated my trend line because price came to surpass this level here. The price came to surpass this level here and came here. So I had to update my trend line. You can see that if we draw our trend line here, price came to respect the trend line that we drew here and started driving down here. Proper. Again, from here, we draw our trend line on the second point here. we extend our trend line further into the future for us to see how future price will come and react on these levels. As long as price stays below the trend line, it is in a downtrend. So in this case, price is making lower highs. As long as price stays below this trend line here, we are in a downtrend, guys. As long as price stays below this trend line here, we are in a downtrend, guys. So price may sometimes break the trend line, but this is not guaranteed that the trend has shifted. It also has to break the previous lower high. That is if we're in a downtrend. So here is an example. You can see price came here, it broke our trend line, retested the trend line, but failed to break our previous lower high. So price did not break previous lower high, so we are still in a downtrend, similar to our weekly level. Once price comes to the trend line, be vigilant and see how price reacts. It might be an opportunity to enter a trade. Since a lot of beginner struggling traders do not know how to apply trend lines, here are some rules and guidelines that you can use to help you with how trend lines can be used and how you can profit from using trend lines. You have to identify two impulsive points. Then you can apply the trend line. In a downtrend, apply it on the lower highs. In an uptrend, apply it on the higher highs. A trend line break does not guarantee a shift in structure. Wait for the previous low high in a downtrend to be broken, or a high high in an uptrend to be broken. Let me make a further point on this one here. When you are applying trend lines on either the lower high or higher high, make sure you apply the trend line on the wicks of the candlesticks. On the wicks, most of you may know them as the shadows, or I don't know what else you can call them, but I call them wicks. So these black lines here, this is the body here. This green and red thing that you see here, these are the bodies of the candle, and this long stick here, this is the wick of the candle. So make sure you apply the trend line on the wicks of the impulsive moves, or the wicks of the candlesticks that are at the top of the impulsive moves. When a trend line is broken and price has changed its trend, price will usually come back to retest the trend line. This may not be the case all the time. Let me give a brief explanation on this point. So as you can see here, price broke our trend line here and came back to retest the trend line. But most of the time, price may not come back to retest the trend line here. It may break the trend line and continue to go further upward and continue making new higher highs without even retesting the trend line here. We go to the next point on how we can identify market structure, and that is using moving averages. Moving averages are a lagging indicator. I made a video explaining what indicators are and how they can be used in trading. Make sure to watch it. Here's the link to the video. We can identify a trend continuation or a trend reversal by the moving average crossover. And of course, the higher the time frame, the more significant the crossover is. Just like the trend line, the moving average can be used for reading market structure and an entry confirmation too. So here is the moving average on the monthly time frame. Moving average cross upwards, meaning price is in an uptrend. So here we have a moving average cross. I have two moving averages on my chart, which is 8 EMA, which is the black one, and the 21 SMA, which is this orange one here. So whenever the black one goes above the orange one, I consider the trend to be an uptrend, and whenever the black one crosses over the red one here, I consider the trend to be in a downtrend. So you can see here our moving averages crossed over to the downside and price stayed below the moving averages and it was in downtrend. Here we have a crossover. The 8 EMA went above the orange EMA. We are still in an uptrend. The price did not go below the moving average and we never had a crossover here. So this was not a significant change of trend for me. Instead, the moving average acted as dynamic support. So you can see here in the video about trading indicators, I explain about moving averages and how they can also be used as dynamic support to help you maximize profits in the market. So here, as you can see, we have a crossover to the upside, so giving us confirmation that our trend is up. We go down to the weekly. If in the higher time frame, that is the monthly time frame, the moving average is in an uptrend and the weekly time frame is in a downtrend, then price in the weekly is in a retracement. So here you can see us having an uptrend here. Our moving average was up here and price began to decline down here, but our moving averages on the monthly here were still crossed upwards. But when we go down to our weekly time frame, our moving averages crossed over here. So this means that in our weekly time frame, price was just making a retracement to come and retest a level and find support so that it can continue going upwards. So when the two time frames are correlating, then we are in the direction of that trend. So when the monthly time frame is showing us that price is in an uptrend, or the black moving average crosses over the orange moving average, and on the weekly the black moving average also crosses over the orange moving average, then we are in a confirmed uptrend. In this case, price is above the 8 EMA, the black moving average. So here there's a higher possibility that the 8 EMA will go above the orange moving average so that we may continue with our upward move. We go down to the daily. So on the daily, the moving average has crossed over upwards. This gives us further confirmation that we are in an uptrend. Now we have to mark significant levels, if there are any significant levels on the daily time frame, and go down to the H4 time frame and stock any entry levels you have marked on. These entry levels are marked on the daily, and you can see how price will react at these levels so that you may potentially make a trade. Make sure the trade is in line with the trend of the market. So in this case, it's uptrend. I look for significant levels. So like this level here is a significant level. We also have this level here. We have one here. We have one reaction here, a very strong reaction from this level. We also have another reaction from this level. We have another reaction. So again, you can see price came to find support at this exact same level. Now down to the H4 time frame. So from our higher time frame, the monthly time frame, we have confirmed that price is in an uptrend and maintaining structure, making high highs as it goes up. So we have got a high high here, another high high here. So you can see another high high here. So you can see how I marked my trend line on a week here, on a week here, on a week here. So eventually we had a trend line break, but structure is not broken. Price finds support at the last high, continuing with the uptrend. So we had a trend line break here. You can see the trend line break here, and we had a retest here, but price never broke our previous high here. Here you can see it broke the trend line but never broke this previous high here. Here we had a retest on the trend line, but again it never broke this previous high, and we continued with our uptrend with 1, 2, 3 solid bullish candles, meaning the momentum is still up. The momentum is still with the bulls. So this is how you can use trend lines to identify market structure. Always use top-down analysis on all the market structure tools you are using. Top-down analysis allows you to identify the trend and allows you to trade in the direction of the trend. If you have any questions, again, don't forget to leave them in the comment section below, and you can also DM me on Instagram. Then we come to the last one, which is the Fibonacci tool. The Fibonacci is an instrument used to measure price correction or retracement. A retracement may also be considered as a price correction, because when price is in a trend, it does not make one impulsive move. It has to make corrections or retracements before continuing its impulsive move. You may call this retracement as higher highs or lower highs. These are the corrections that I'm talking about. The point at which price may retrace to and begin to make an impulsive move is measured by the Fibonacci tool. So this is what we use to measure the correction of price. This is what is called the Fibonacci tool. The numbers here are represented from the Fibonacci sequence. For those that don't know the Fibonacci sequence, you can go ahead and Google it. I do not have time to start explaining the Fibonacci sequence. That is out of context from what I am explaining right now. With the Fibonacci tool here, we have these levels here. Let's begin with these levels up here. So we have the negative 61.8, we have the negative 27, we have the 0, we have the 38.2, we have the 50, we have the 61.8, we have the 78.6, and we have the 100. Price, usually when price is retracing, let's take for example, we are in an uptrend. So if we are in an uptrend, we would like to draw our Fibonacci from the previous higher low to the recent higher high. That is when we are in an uptrend. Draw our 100 from the previous higher low to our recent higher high. Then when price begins a retracement, it may come to bounce off one of these three levels here. It rarely comes to bounce off 38.2, and when it comes to bounce off 38.2, I usually don't take the trade because the probability of it being a winner is very low. The high probability levels are the 50% level, the 61.8, and the 78.6. We have the golden zone where price mostly comes to retrace, which is the 61.8 and the 78.6. When price comes to retrace at in between these levels or at this level here, it has a high probability of it continuing with its trend direction. These levels here, the negative 27 and the negative 61.8, these are target levels. These are the levels that you can use to place your take profit. So how to use the Fibonacci? For those that don't know how to use the Fibonacci, this is how you use the Fibonacci. So in this case, we are in a downtrend. So you click your Fibonacci tool and you place it on your lower high here. You place it on your previous lower high here and lower low here. Let's take for example this retracement never existed and price has begun to make a retracement. So you drag your Fibonacci from the top here down to the bottom here, and the correction will begin, and these two will measure the correction. So to plot your Fibonacci, price has to make an AB pattern, and to complete it, it has to make a CD move. So this is the AB pattern. It has to make this pattern first. A, B. The retracement is the C. Then our impulsive leg is the D. Price respected the monthly trend line very well. This is our monthly trend line here from the trend line example that we had, and began to decline. We can see that price made a retracement and found resistance at the 50% Fibonacci level, finding resistance at the previous support level, this previous support level here, and began to make an impulsive move. It eventually hit our take profit level. Our take profit level is -27. This is where I place my take profit and let the trade run like that. So this is how you place your Fibonacci. In an uptrend, we usually place it the opposite way, from our higher low to our higher high. Here's an example of using the Fibonacci in an uptrend. So we have a break of structure here, price was in a downtrend. You can see these lower highs being made here. Then here we had another lower high here. Then eventually we had a break of structure, shifting the trend, and price began to retrace. So we broke it here, shifted the trend, price began to retrace. It retraced back to the 78.6 level here, our last line of defense. No, actually our last line of defense is this previous higher low here. So, and it began its impulsive move upwards. So as you can see, we have our A, we have our B, and we have our C here. Then we come to have our D here, which is the impulsive leg upwards. So this is how you can tell market structure using the Fibonacci tool. Whenever price comes down and breaks this last level here, it means that price has shifted its trend and will now begin a downtrend. So a Fibonacci tool is very useful of measuring the correction of the trend and allowing us to take advantage so that we can open a trade when the trend has made a retracement. Thank you very much for watching the video this far. If you have gained any knowledge, don't forget to like, share, and subscribe with your friends. You can follow us on Instagram at Magna FX Institute, and you can join our Telegram channel where we post exclusive content that cannot be shared anywhere else. You can also find this slide on our Gumroad, including other slides, also including a sample of a trading plan and the elements that are needed for a trading plan to be made. I'll make sure to leave the links in the description below. Thank you very much, and see you in the next video.